Have you ever stopped to think about what actually keeps our financial world, stable? It's not just big vaults and fancy security systems. Nope. It's really this invisible architecture of rules, a super complex system that's designed to do one thing: keep banks strong so the economy can keep moving. So today, let's pull back that curtain and take a look at the core of it all: bank capital management.
So let's just cut right to it. It's a simple question, but the answer is incredibly important. When a bank gets in a real trouble, what is the actual, tangible cushion that stops it from completely collapsing? The answer to that question is really the foundation of all modern financial regulation. But before we get to that answer, you have to understand this fundamental tug-of-war that regulators are always dealing with. On one side, you have to make banks almost bulletproof to protect our money and, well, the entire system. But on the other side, if you make the rules too strict, it becomes really expensive for banks to lend money, and that can grind the economy to a halt. It's this constant tightrope walk between safety and growth.
So how do they manage this balancing act? Well, regulators came up with a system built around one core idea: a safety buffer. You can think of it like a financial shock absorber, something that's specifically designed to take the big hits when things go wrong.
And that buffer has a name. It's called a capital requirement. It's basically a rule that forces a bank to have enough of its own money on the line, we're talking about shareholder money here, to soak up any unexpected losses. It's all about ensuring the bank's owners have skin in the game and take the first hit, long before your deposits are ever at risk.
Okay, but how do you know if that buffer is actually big enough? To figure that out, regulators created a central formula. And this isn't just a local thing, it's become the bedrock of banking supervision all over the world, thanks to these global standards you might have heard of called the Basel Accords.
And here it is. This is the formula at the very heart of everything. It's called the capital adequacy ratio. You take the bank's capital, that's the numerator, and you divide it by its risk-weighted assets, or RWA, that's the denominator. The number you get has to be above a minimum percentage set by the regulators. It looks simple, right? But trust me, the magic, or maybe the madness, is all in the details of those two terms.
Let's make this real with some numbers. Say a bank has $100 in risk-weighted assets. If the minimum requirement is 8%, then that bank has to hold at least $8 of high-quality capital. Simple enough. But this immediately brings up two massive questions. First, what exactly counts as capital? And second, how on earth do you calculate those risk-weighted assets?
All right, let's tackle that first question and zoom in on the numerator. Because, you see, not all capital is created equal. Regulators came up with this really strict hierarchy, what everyone in the industry calls the capital stack, and it's all based on one thing: how good it is at absorbing losses.
So the stack has three main layers, and each one has a very specific job. Right at the bottom, the absolute best, highest quality stuff is Common Equity Tier 1, or CET1. Then you've got a layer called Additional Tier 1, and on top of that, Tier 2 capital. Let's dig into what makes each one different.
Now this is where it gets really interesting. CET1 is the absolute gold standard. It's mostly the bank's common stock and its retained earnings. Basically, the purest form of capital that takes the very first hit from any losses. AT1 is a bit more clever. These are often instruments called contingent convertibles, or CoCos. Think of them like a financial tripwire. If the bank's capital drops below a certain point, poof, these bonds either get written off completely or convert into equity to shore up the bank. It's designed to help while the bank is still a going concern. And then there's Tier 2. This is mostly debt that's subordinated, meaning in a failure, it only gets paid back after all the depositors. It's there to protect depositors if the bank is a gone concern and is being wound down.
Okay, that's the top of our fraction, the numerator. So now for the second part of our puzzle, the denominator. What in the world are risk-weighted assets, or RWA?
I mean, $100 is $100, right? Well, in banking, not so much. Lending $100 to a stable government is obviously way less risky than lending that same $100 to a brand new startup. The whole point of the RWA calculation is to capture that exact difference in risk. And here's how that works. A safer asset, like a solid home mortgage, gets a low risk weight. So that $100 loan might only count as, say, $35 toward the RWA total. But a much riskier unsecured loan could get 100% risk weight, meaning the full $100 gets counted. And remember, the higher the RWA, the more precious capital the bank has to hold against it.
But here's the catch. This whole system is only as good as the risk weights you put into it. And as this quote reminds us, that can go horribly wrong.
Before the 2008 financial crisis, a lot of really complex mortgage products were given super low risk weights. The models basically said they were safe. Well, the models were wrong. When they collapsed, banks found out they had nowhere near enough capital to cover those unexpectedly large losses. It was an absolutely brutal lesson in how theory can crash into reality.
So to actually calculate these RWAs, banks have two main options. There's the standardized approach, which is kind of the off-the-shelf version, where regulators just tell you what risk weights to use. It's simple, it's consistent. Then, the biggest, most sophisticated banks can get permission to use their own internal models, the IRB approach. But, as you can imagine, this comes with a huge catch. Regulators have to sign off on these models to make sure banks aren't, marking their own homework too generously.
So we've got our core ratio. But as 2008 proved in spectacular fashion, just meeting the bare minimum isn't enough. So after the crisis, regulators basically said, okay, that's the foundation, now we're adding a bunch of extra layers of protection on top.
On top of that minimum, banks have to hold a whole set of buffers. There's the capital conservation buffer, which is just an extra 2.5% rainy day fund. Then there's the countercyclical buffer, which is a clever tool regulators can use to force banks to build up more capital when the economy is booming, so they have extra padding for the inevitable bust. And finally, the biggest, most connected banks, the ones often called too big to fail, they have to hold even more capital in a special systemic importance buffer. And what about that big lesson from 2008, where the risk weight models were just plain wrong? Well, regulators brought in a simple but incredibly powerful backstop, the leverage ratio. It's a game changer because it completely ignores all the fancy risk weighting. It just asks a simple question. How much capital do you have compared to your total, unweighted assets? It's a brute force reality check. And the minimum for this simple safety net is usually about 3%. It just makes sure that no matter how safe a bank's complex models claim its assets are, there is always a hard, non-negotiable floor of capital underneath it all.
Okay, so everything we've talked about so far, the ratios, the buffers, the whole shebang, that's all part of what's called Pillar 1 of the rules. Think of it as the cold, hard math. But there's another part, Pillar 2, that adds a crucial human element, the actual judgment and oversight of the supervisors themselves.
And Pillar 2 is all about a dialogue. First, the bank has to do its own homework, a really deep, honest look in the mirror at all the risks it faces. That's called the ICAP. But then, to make sure they're being realistic, the regulator comes in to review, challenge, and poke holes in that assessment. And that's the SREP.
And this whole back and forth is key, because if the supervisor thinks the bank missed something or is being too optimistic, they can actually slap on extra, legally binding capital requirements. That's a Pillar 2 requirement, or P2R. They can also issue softer recommendations, which are called Pillar 2 guidance, or P2G. The whole point is to tailor the rules to each bank's unique risk fingerprint, to go beyond the one-size-fits-all formulas of Pillar 1.
And that brings us right back to where we started, to that fundamental tension. This entire, incredibly complex system of ratios, buffers, and human reviews is all just a constant search for that perfect point of balance. A system that makes our banks safe enough to survive the next storm, but not so tied down that they can't provide the credit that fuels the economic growth we all rely on. It's a moving target, and it's the question that regulators and bankers are still debating every single day.